P. Jairam Bhatt, Managing Director and Chief Executive Officer of Karnataka Bank, joins us from Mangalore to talk about Q2 numbers. Mr. Bhatt, good morning. Thank you for joining us. The net interest income growth has been healthy for Karnataka Bank for the quarter gone by. However, your margins were down. What led to such a sharp erosion in your margins?
The net interest margin for the quarter has gone up. It has gone up to 2.63 from the last year's 2.40. Substantial jump is there. And net interest income also went up by 22.30% up. And for the half year, for 6 months period, net interest income has gone up by 17.62. As well, our operating surplus is also as per the target. We had shown a growth rate of around 30.96% under our operating surplus from 327.70 crores to 429.14 crores and showing a growth rate of 30.96%. And for the half year, the net interest margin was around it was at 2.51 for the half year as against 2.40 for the last half year.
Mr. Bhatt, what's been your dependence on bulk deposits now, and in what range do you see your margins in the next 2 to 3 quarters?
Margins should improve in the next 2 to 3 quarters, and the whatever NPAs there was delinquency in NPAs in this quarter. These are all under substandard category, and some are referred to CDR. And once the CDR structure is settled, this will come out of NPA, and definitely the provisioning which has been done to these bulk loan accounts as well as the unrealized interest therein would be accounted for income, and our margins shall improve in the next coming quarters.
Mr. Bhatt, asset quality has deteriorated on a sequential basis. What have been your slippages and recoveries for the quarter gone by?
There were slippages of around 206 crores in this quarter and recovery of around 66 crores. So that is why the NPA has gone up, and percentage-wise, the gross NPA is at 3.59 as against 3.22 in the corresponding last quarter, and net NPA is also as against 2.08, it has gone up to 2.25. And these accounts, as I told you, there are some big ticket accounts which are referred to CDR and which will come out in the third quarter.
So which sectors, according to you, continue to be under stress?
Mainly in the power sector, and also in it's a major general industrial sector, and some are in construction sector.
What has been the addition burden because of restructured assets for Karnataka Bank?
These restructured assets in the quarter was 177 crores, and these are all under standard status.
And how do you see your slippages in the next 2 quarters?
Yeah, we are confident because CDR, these are accepted in the CDR. Only the restructuring exercise is yet to take place. These are accepted in the CDR, and definitely it will be, the restructuring exercise will take place within another 2 months.
You've taken a massive treasury hit during the quarter. Give us some color on this.
During the quarter, there was a treasury hit of around 57 crores. Compared to the last year's second quarter, there was an increase of 57 crores of depreciation, and the hit what we have taken for depreciation in this particular quarter was around 19 crores, and added to that the further depreciation, it totaled to 57 crores in this particular quarter.
And how do you see your treasury book performance going forward, given that 10-year bond yields are expected to remain high as the RBI is expected to hike repo rates?
No, I don't think yield level will come down, because I don't subscribe to the view that RBI is going to increase the repo rate. Rather, there is a news that tapering will take place only in June 2014. If that is the case, definitely bond prices, bond yields will come down. And even whatever we have provided for depreciation we may get reversal under those sectors.
The deposit growth also was rather muted. How do you see your CASA growth shaping up in coming quarters?
No, this deposit growth is 11%, no doubt. But we have not accepted any bulk deposits as other PSU banks have been doing. Our bulk deposit proportion is around 1.5 to 2%. That being the case, our deposit growth, even though it is 11% compared to 14% industry, I should say that it's a good growth under the present circumstances.
And your credit growth, because that has been strong at a good 18%, what's the future outlook?
It all depends on how we get the credit proposals. If it is, say, AAA rated companies and all that, we may even go at base rates also, thereby increasing the credit growth, because the surplus funds have to be invested. And there are some good SMEs coming, and we have appointed about 100 marketing officers at our end now. So we are continuously tapping the market, and going forward, I should say YOY credit growth will be around 20% plus.